In news that we are breaking to you, in a relief for the homeowners, home loan rates are likely to get cheaper. The RBI has cut repo rate by 50 basis points. CRR remains unchanged at 4%. Devina now joins me on the phone line. Over to you, Devina, for more details.
Well, Afrida, it's a big relief that is coming in for those who've taken home loans and car loans as well, because now we can expect that the banks will likely pass on the rate cut which has been announced by the RBI. In a short way, what repo rate means is the lending rate at which the apex bank lends to the consumer banks. So if that goes down, which has gone down by about 50 basis points, what it means is that now borrowing becomes cheaper for the banks, and that would result definitely in being passed on to consumer in form of cheaper home loan rates and cheaper auto loan rate as well. But the reason behind the rate cut could obviously be seen as cooling off the inflation that we have seen in the recent time. We've also seen that how the US Fed has kept the rates unchanged, giving a cue and room for the central bank also to cut rates. We've seen that how Finance Minister had asserted that it is likely that the interest rates should come down as inflation is very much under control, and it is coming as a big relief. We are expecting Raghuram Rajan now to speak anytime soon as he also talks about the bi-monthly RBI policy.
Since our last review, the bulk of our conditions for cutting interest rates have been met. The January 2016 target of 6% inflation is likely to be achieved. Therefore, the focus should now shift to bringing inflation to around 5% by the end of fiscal 2016-17. With weakening global activity since our last review, commodity prices will remain contained for a while. With low industrial capacity utilization, more domestic demand is needed to substitute for weakening global demand so that the domestic investment cycle picks up. The coming Pay Commission report could add substantial fiscal stimulus to domestic demand, but the government has reaffirmed its desire to respect its fiscal targets and improve the quality of its spending. Under these circumstances, the Reserve Bank intends to be accommodative to the extent possible, given its inflation goals, while recognizing that continuing government policy implementation, structural reforms, and corporate actions leading to higher productivity will be the primary impetus for sustainable growth. Now, we do believe that investment as well as durable goods purchases are likely to respond more strongly if there's more certainty about the extent of monetary stimulus in the pipeline, even if transmission is slow. Therefore, the Reserve Bank has front-loaded policy action by a reduction in the policy rate by 50 basis points. Given our year-ahead projections of inflation, this ensures that 1 year expected Treasury bill real interest rates of about 1.5 to 2%, which we think is appropriate for this stage of the recovery. While the Reserve Bank's stance will continue to be accommodative, the focus of monetary action for the near term will shift to working with the government to ensure that impediments to banks passing on the bulk of the cumulative 125 basis points cut in the policy rate are removed. This includes, amongst other things, reviewing small savings rates. The Reserve Bank will continue to be vigilant for signs that monetary policy adjustments are needed to keep the economy on the target disinflationary path. Now, we've laid out a number of other policies today. We have a medium-term framework for foreign portfolio investment in government bonds with a target of allowing FPI ownership of up to 5% by March 2018. We'll also open FPI investment in state government bonds with a target of 2% by March 2018. Now, altogether, this implies incremental space of about $25 to $30 billion over the next 2.5 years, of which $5 billion will open up immediately over the next 6 months. The intent here is to create more room steadily to slant towards long-term investors and to help develop domestic markets. We've also opened to masala bonds. I think that's the name they're called by. These are rupee bonds, and we intend them to have a minimum maturity of 5 years. They can be issued abroad, or they will be issued abroad. For the moment, they will come under the overall corporate FPI limit.